To understand the collapse, you first have to understand how dull the savings and loan was supposed to be. At the start of 1980, the federal insurer F-Slice backed roughly 3,993 of these thrifts, holding about $604 billion in assets, almost all of it in plain home mortgages. The business model was simple. Take in short-term savings deposits, lend them back out as 30-year fixed-rate mortgages. It worked for decades while interest rates stayed low and stable. That stability was about to end. On the evening of Saturday, October 6, 1979, Federal Reserve Chairman Paul Volcker called a rare press conference and announced the Fed would stop targeting interest rates day to day and instead clamp down on the growth of the money supply, deliberately letting rates rise to break double-digit inflation. This is the starting gun. Volcker had taken office that August, and the consequences for thrifts were swift. Short-term rates soared past 15%, then higher, and the federal funds rate touched a peak of about 20% by June 1981. Here is the fault line the rate shock exploited. A thrift's income was locked into old mortgages booked at 6 to 8% in the 1960s and 70s. But the deposits funding those mortgages now had to pay double-digit rates to keep savers from leaving. Between June 1979 and March 1980, short-term rates jumped more than 6 percentage points, from 9.06 to 15.2%. The industry was suddenly paying more for money than it earned on its loans. In 1981 and 1982, the average interest spread went negative, minus 1.0% and minus 0.7%, meaning thrifts were losing money on each dollar lent. It got worse from the funding side. A Depression-era rule called Regulation Q capped what thrifts could pay depositors around 5.25% on passbook savings, while new money market mutual funds paid well above that. So savers simply walked their money out the door, a process economists call disintermediation. The thrifts were bleeding on their assets and losing low-cost deposits at the same time. By mid-1982, the math was brutal. Valued at market prices, all savings and loans combined had a negative net worth of about $100 billion, equal to roughly 15% of the entire industry's liabilities. Across 1981 and 1982, they reported about $9 billion in accounting losses, and tangible net worth fell from 5.3% of assets in 1980 to barely 0.5% in 1982. The crucial point. On a market value basis, the industry was already insolvent before the famous fraud or junk bond gambling began. This was a rate story first. Washington now faced a fork. By year-end 1982, there were 415 thrifts holding $220 billion in assets that were already insolvent on a tangible net worth basis. Closing them was estimated to cost the FSLIC Insurance Fund around $25 billion, but the fund held only about $6.3 billion in reserves, roughly a quarter of what was needed. So regulators largely chose forbearance. Keep the dead thrifts open and hope they grow out of it. That choice helped convert a contained interest rate problem into a decade-long catastrophe. Two laws then handed insolvent, government-backed institutions far more room to take risk. Carter's DIDM-CA, signed March 31, 1980, began phasing out Regulation Q and raised deposit insurance from $40,000 to $100,000 per account, which experts later said worsened moral hazard. Then Reagan's Garn-St. Germain Act, signed October 15, 1982, let thrifts move into commercial real estate, consumer and commercial loans, and direct investment. At the signing, Reagan called it, quote, the most important legislation for financial institutions in the last 50 years, and added, all in all, I think we hit the jackpot. Critically, these new powers came with no matching increase in supervision. Regulators then made the bodies harder to see. The Federal Home Loan Bank Board cut the required net worth from 5% in 1980 to 4% in November 1980 and 3% by January 1982, and adopted lenient regulatory accounting principles that let thrifts count goodwill as capital and defer losses. Supervisory goodwill ballooned from about $7.9 billion in mid-1982 to $22 billion by late 1983, about two-thirds of all regulatory capital. The leverage was extreme. A new institution could turn $2 million of capital into $1.3 billion in assets, a multiple of about 650 to 1. Technically insolvent zombie thrifts now looked alive and kept full government backing. With insurance covering deposits and no extra premium for risk, zombies gamble for resurrection. Deposit brokers sliced money into fully insured $100,000 pieces and shipped it nationwide to whoever paid most. Thrifts plowed that hot money into Michael Milken's junk bonds and speculative real estate. Charles Keating's Lincoln Savings became the emblem. It poured money into Drexel junk bonds and speculative ventures and defrauded roughly 23,000 mostly elderly bondholders. Its 1989 failure cost the government on the order of $2.6 to $3.4 billion. 5 U.S. senators who had received about $1.3 million tied to Keating intervened with regulators, the scandal that became the Keating Five. Then the speculative assets imploded. The Tax Reform Act of 1986 killed real estate tax shelters and lengthened depreciation schedules, helping end the building boom that thrifts had financed. At the same time, an oil price crash gutted the Southwest. Texas became the epicenter, accounting for about 40% of all thrift failures in 1988, the worst year, and for the majority of national losses by 1987. Empire savings of Mesquite, which ballooned from about $13 million to over $300 million on fraudulent land flips, had already been seized in March 1984 at a cost to the government of hundreds of millions. The fund meant to protect depositors now ran out of money. FS-like's reserves fell to $4.6 billion by August 1985, and the GAO declared it insolvent by at least $3.8 billion in January 1987. Congress responded with the Competitive Equality Banking Act of 1987, authorizing only about $10.8 billion, an amount the FDIC's own history calls clearly inadequate. That underfunding forced still more forbearance, which by one estimate accounted for roughly $60 billion of the eventual losses. The reckoning came on August 9, 1989, when President George H.W. Bush signed FIRREA. It abolished the bankrupt FS-like and the Bank Board, moved insurance to the FDIC, created the Office of Thrift Supervision, and built the Resolution Trust Corporation to seize and sell the wreckage. The RTC, led by William Seidman, resolved 747 thrifts holding roughly $400 billion in assets, pioneering bulk asset sales and securitization, before shutting its doors on December 31, 1995. Between 1986 and 1995, the number of insured thrifts was cut almost in half, from 3,234 to 1,645. The FDIC's authoritative tally puts the total cost at about $152.9 billion, of which roughly $123.8 billion fell on taxpayers and $29.1 billion on the industry. The GAO's wider estimate ran to about $160 billion, with most of it borne by taxpayers. And unlike 2008, people went to prison. Regulators made over 30,000 criminal referrals, and from 1988 to 1992, the Justice Department won 2,603 convictions and sent 1,706 bankers to jail. Yet fraud was never the main driver. By one widely cited estimate, criminality accounted for only about 3%, roughly $5 billion, of the FS-like bailout cost. The real killers were the rate shock, mispriced insurance, and forbearance. This is not ancient history. The same mechanism that crippled the thrifts, holding long-duration fixed-rate assets funded by short-term money that reprices when rates rise, is widely cited as a key factor in the 2023 failure of Silicon Valley Bank. The practical lessons are concrete, and they are general, not personal advice. First, FDIC insurance is a shield and it is finite. Standard coverage is $250,000 per depositor, per insured bank, per ownership category. Second, duration risk is timeless. Long-term bonds and bond funds can lose market value when rates rise, so it is worth understanding how the time horizon of your savings lines up with your instruments, and remembering that even assets considered safe can fall in price.